So I think this is a great starting point for the discussion, right? The ability to invest in a broad set of asset classes, not restricting yourself to a narrow subset that has performed really well over a very convenient or a very uh, benign regime. But the next point is to say, okay, how do we implement some of these things? And Adam, when you were describing the sizing of a risk parity portfolio that has bonds more weighted than stocks, for instance, I can imagine a lot of people's alarm bells are going off because of what's happening to bonds recently. And what we then get into is a discussion about how when volatility spikes for an asset class that is falling and correlations come in for equities and bonds, you would de-emphasize bonds in the portfolio and increase the allocation to asset classes that have been doing particularly well recently, which lowers their volatility, right? So, which obviously is commodities and has been commodities for a 12 to 18 months.
Yeah, I mean, I think it's important to recognize that there are a variety of ways to sort of skin the risk parity cat, so to speak. Obviously, one of the earliest exponents of the concept was Bridgewater and Ray Dalio with their all-weather portfolio, and they took the view that portfolio construction should be a function of fundamental economic drivers and economic risks of each of the different asset classes. And they set a strategic portfolio. In other words, basically fixed weights is our understanding anyways. I haven't worked at Bridgewater, but I've certainly digested all the material that's out there to digest on it. And it seems that they set a strategic long-term asset allocation. And so, for example, during March 2020, when equities were falling, the Bridgewater all-weather portfolio would be rebalancing by selling bonds, which had gone up in value and probably overrepresented in the portfolio relative to the strategic target, and would be buying equities on the way down. Now, that contrasts with many of the commercially available funds like AQR's fund and the Invesco fund and some other implementations where the portfolio actually changes in constitution through time in reaction to changes in estimated correlations and volatilities, et cetera. And also, to your point, Richard, changes in terms of total portfolio exposure, right? So we sort of conflated 2 points there, but I think we need to get back to that original one, which is if you have a portfolio that's in proper balance, then it probably holds an abundance of bonds because bonds have much lower risk than both commodities and stocks. And obviously a portfolio that holds an abundance of bonds would probably be expected to have maybe too low an expected return to meet most investors' investment objectives. And so, I mean, there's 2 ways that you can increase the expected return on that portfolio. One is to increase concentration in the sleeves of the portfolio that might be expected to deliver higher absolute returns. So for example, sacrifice diversification by increasing your exposure to equities, or if you've got a strong inflationary view, increasing your concentrated exposure to commodities. The other way that you can do it is to preserve the diversity and balance in the portfolio and then borrow to increase the total exposure. So maybe instead of having 100% exposure to this diversified balanced portfolio, you've got 200% exposure or 300% exposure, right? In order to hit different risk return targets. And so to that end, sometimes, or some risk parity implementations, when they, the estimates are that volatility is increasing and correlations are collapsing towards 1, they need to reduce aggregate portfolio exposure in order to preserve their target portfolio volatility. And then they'll expand that exposure when volatility calms down and correlations become, closer to normal again. But then of course you've got, and those will act pro-cyclically at times. So we would expect those types of implementations to be selling equities, selling bonds, and selling commodities into a major drop like March of 2020. But at the same time, the more strategic implementations like Bridgewater's all weather, like we already talked about, will be increasing their allocation to those markets at the same time.
Countercyclically.
Countercyclically. So, there should be a balancing effect in markets that would prevent these, more pro-cyclical risk parity implementations from exacerbating in any material way the moves in markets in one direction or another.